Hey everybody, it's Pete. Welcome to Stock for Breakfast. And today we're going to talk about why I don't love the current price action and how that should translate into position size, and more specifically, initial position size. I'm going to walk you through a lesson today of something that actually happened at 5:30 this morning in our community. And yes, 5:30 in the morning, we are answering questions. And this is a really important thing to understand as a trader, because in market conditions that are a little bit less than perfect, it's very important that you can recognize perfect and everything away from perfect, because that same scale should be increasing or decreasing your position size. Now, the reason that matters so much, and this is really, really a critical thing, is that, look, we're going to have losses on our trades. There's really no other way to put it. You don't need to be perfect. You need to have the right position size on the trades that work out, which could be bigger initial position size, and on top of adding to positions as they move in your favor. That's never the problem. The problem is when you have bigger position size in ideas that don't warrant it. That's the problem. And learning to recognize that is what will elevate your trading to a level that you could not possibly have imagined. And it's not because you're noticing something secret. It's basically that you are reading the market instead of forecasting it and saying, this is the situation I have right now. Here's all the information for the current stock pick I'm looking at. And then you make a decision on position sizing. So I'm actually going to tie that back into not only the amount of positions to put on an individual moment in time, but then how to adjust that position size based on the quality of that trade. I'm going to walk you through some of that today. I'm also going to walk you through the picture perfect price action that I like to see and why I'm not seeing it right now. Even though the market is resting at all-time highs, it still feels very uncomfortable. And I don't like to feel uncomfortable when I'm out there accepting risk, because the whole job of traders is accepting risk because we have a very likely reward potential. And it's kind of weird because we're the SPY, the S&P 500 is right near those all-time highs. We haven't pulled back at all, but what we're not seeing right now is tradable volatility. And that's a big thing for me, because if you've been in our community for a while, and thank you for being here with me on YouTube, is that I kind of like to see push and pause. And the reason I like that is there's institutional attention on those stocks, and they're buying and they're taking a break, and they're buying and taking a break. And right now we're seeing a lot of stocks that had that rocket ship move for the end of 2023, kind of feeling the effects of that right now. If you could kind of imagine a bunch of kids running around on, all hopped up on candy, and then all of a sudden they kind of just pass out. And that's kind of what the market's doing right now. We had that massive move to the upside, and then we kind of like, not so much drifting, but we're not seeing back and forth, which just means there's no new opinions, for lack of a better way of putting it. When I say opinions, I mean institutions that have new research and ready to do something. Up till this moment, starting with 2024, it's mostly been selling the news. So in other words, earnings has come out and the stocks have rallied a really big amount, and news came out and we kind of went in the other direction. We do have a couple of earnings coming out this morning. We're going to take a look at those prices in a second, but we're going to use JP Morgan as an example of a stock that just had an amazing move. It actually came out with decent numbers and got clobbered the other day. And now we're also going to talk about crypto stocks. Big news last week with the ETF. I'm going to give you some ideas of what I'm looking at today. And we're going to break it all the way down. We got a lot to cover today, so you're probably going to want to watch this video more than once. So stick around. I'll be back in just 1 second. Okay, so thank you so much for joining me here. I really appreciate it. If you happen to be watching this live, make sure you leave a comment here with us. If you have any follow-up questions after the video, leave them below. I promise to get back to you as soon as possible, because we're going to rattle off a lot of stuff. We're going to go through the research that I provide for the community every day. We're going to break down the ideas and how I'm working from the market down to sectors, down to groups, down to possible ideas that I like for this week. But I want to start out with a lesson that came out of our community this morning. And I'm actually going to share that. So there's going to be a lot of stuff I'm going to go over here today. So you might want to watch this video more than once so you can screenshot some of not only the ideas, but the lessons. And the biggest lesson is how I am viewing the current price action in the stock market, and how that's leading me to think about the best stocks to buy right now, and how that's translating into my position size. So I just want to be clear about this lesson before I get into everything else, because it's a really important one. And I just want to say good morning to Joseph. Joseph, good morning. Thanks for being here with us. I know you watch us often and for a while. I just want you to know I really appreciate it. So one of the things I want to discuss here, and it's something that comes up a lot, which is trading losses and the negative emotional impact of having a trading loss. Now, I just want to be clear about this. Everything we're here to talk about is for educational purposes, right? It's my job, my mission to help you make better decisions. And part of those decisions is about having the right mindset, and that includes taking losses. Losses are a part of what we do. I mean, there's a lot of garbage on YouTube where people say, I never have a loss. That's bullshit. You don't need to worry about being perfect. You need to have the right position size and the right expectation for follow through, which means the right expectation for profit potential for that risk that you're about to take in each unique situation. So the part that I want to get across here, and I'm saying this right at the beginning of today's video because it's that important, is that you can have losses in a tougher market condition, and maybe even 2 or 3 of them, and not be angry about it because you lowered your position size because you recognized it was a decent idea, but not fantastic. Fantastic is where the market's perfect, the sectors are perfect, the industry groups and all the stocks in that industry group, and you're at the optimal entry and you have profit potential. What we're seeing right now is either explosions or trading ranges, and that's making for a little bit of a tougher market condition to have confidence. So I just want to walk through exactly what that means. So just bear with me while we kind of get into this right here. And there's actually a pretty decent lesson in here. All right. So buy the rumor, sell the news so far for this year. Amazing bullish run to end 2023 has consequences. So if you're not familiar with what we're talking about this move right here, where there was barely a pullback. Okay. All right. Depending on which channel you watch and which podcast you listen to, the phrase price to perfection keeps getting thrown out into the conversation. On Saturday's swing trade session, John Napolitano, and I'm going to break that down for you in just a second as well, mentioned that we're not going down and he remains bullish. I agree. The SPY ETF continues to hover near that all-time high, and that's what we're seeing right now. But the part that is kind of really sticking out as a sore thumb, and I'll kind of get into, we'll get into Goldman Sachs in a second, but the part of the SPY right now is that we are basically hovering in what can only be called right now a trading range, which is going back to the middle of December. So we are now in a 4-week trading range in the S&P 500 and in the bigger picture of the stock market. So we're seeing a lot of trading ranges right now, and Microsoft stock just actually broke out of one here, PDD in another one here. So we're seeing a lot of trading ranges, or we're seeing explosions like this. So we're kind of stuck between, we're too far from an optimal entry for a new trade, and we're kind of stuck inside of a range. So what does that mean from a perspective of position size? I'm going to walk you through that, and I want to walk you through good ideas and how many good ideas. This is a lesson from this morning. So I kind of want to jam this into the start of the lesson before we get into the picks, because if you're actively trading, one of the most precious assets you have is up here. It's maintaining that mental capital despite tough conditions, not getting too high or euphoric when things are amazing. It's our job to keep things at an even keel and just trade what we see and not project what we want onto the market. So I'm just going to be straight up with you right now. I am finding the market a little challenging to find perfect ideas right now. And that means I am adjusting my position size. So I just want to be super clear about this, and I want to challenge you to do the same thing. Whatever your trading strategies, obviously mine is order flow and order flow stacking. So order flow is institutional orders coming down into the market. Order flow stacking is the process of having our software and our algorithms set up properly to tell us how long institutions have been buying a particular stock. Is that infected in industry groups? Is that infected in sectors? And in other words, how spread is that order flow? Then order flow stacking is how long has that been happening? Is it still valid and has it changed? Now, that's very, very different from what a lot of people believe you need to do in the stock market, which is predict. We don't predict. It's not necessary to predict. And quite frankly, predicting doesn't work. But we have a lot of control over saying, here's what's happening right now. How many reasons can we put into that idea? And that's going to increase or decrease our conviction in that idea. And then based on how our increase or decrease in conviction will go, that should also increase or decrease our initial position size. Now, I want to be super clear about what I'm talking about. Initial position size. So for that moment, what is the right amount of shares and what is the likely initial target to start that trade? That's the point that I want to get across right now, and this is the lesson I want to walk you through. Okay, so this is actually from this morning. So I agree with John, and we're going to get into John's breakdown in just a second. But to be honest, I'm not loving the price action. 3 weeks ago, I reduced my initial position size, and I don't see areas to change that. So far this year, we're getting explosions or trading range, which is not an easy environment to have conviction. Now, we get a lot of people saying, well, I understand that, but show me what you're looking for. And I don't know that we have a better example than RCL, Royal Caribbean. Basically, during that move where the market started that rally at the end of October and into November, but it had perfect price action where you could see buying pressure and slowing down and buying pressure and slowing down. So what I'm trying to get across to you right now is when you have a roadmap for what perfect looks like, then you put that roadmap over the market and you say, am I seeing that right now? And the answer to that, either yes or no, should dictate position size up or down, if you should even put the trade on in the first place. So I want to put this chart on the screen so that you can actually take a snapshot of it and have the visual representation of that. So if we're basically talking about this, when the downtrend broke over here. So you can see we had two big gaps breaking this trend, and that was the start. That might be what we call initial stage, early stage order flow. But then it got validated. We paused and we pushed. 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 And we're not seeing that right now in the big picture. A lot of stocks, including the market now, although we're at a breakout level, we're kind of going sideways. So we're not seeing that flow of new money coming into the market. Right now, what we have in the bigger picture is kind of status quo. So here's what that means, all right? Brings me to an important point, but really the point here is about conviction. How do you as a trader map out your conviction level? How do you look at price action? How do you look at technical analysis? How do you look at charts? How do you look at fundamentals to come up with reasons to choose to accept risk? That's setting your conviction level, all right? Conviction has to be, what is the likelihood of my profit target being hit on that stock pick versus my stop loss? And again, everybody forgets this. It's probability. There's going to be losses. And if you happen to be new to the channel, I just want to be super clear about this. I live in reality. Unlike a lot of people, I live in reality. I could put on a great trade that might not make money, and that's fine. When you get into the point of what a strategy means, a strategy should have an edge. An edge means most of the time that profit target will get hit versus the stop loss. But that explicitly also means sometimes it won't. Sometimes great ideas will not follow through, and that's fine also. That's a part of what we do. But to be a consistently profitable trader in the stock market, you have to flawlessly get out of the ones that are not working and accept that as a part of trading, and then learn how to size up and hold longer on the winners. It's not complicated, but most people don't spend their spare time making a cup of coffee, writing out what works, and then doing more of that while you're making a big list of what doesn't. And I will tell you flat out, the number one reason that smart people are inconsistent in the market is they don't accept losses. Get over it. It doesn't mean you're a bad person or a bad trader. It means that particular idea did not follow through. And that's fine. That's a part of what we do. There's no business in the world that doesn't have business expenses. Every business has business expenses, and trading is the same. A trading loss is a business expense. Okay, now we're going to tie that into the ideas for this week and how we're going to look at them. All right, so brings me to that point. I'm excited to trade. You're excited to trade, but some situations are simply better than others. And we need to be smart with position size when it's less than perfect. Snapshot that part. It's very important. This conversation we had in the community this morning is one to print out and one to remember. And yes, it was 5:38 in the morning, and I want to thank Henry for the question. So here's the question. I practiced a little with my demo account on Interactive Brokers, and I'm ready to take my first swing trades. Is it better to have a maximum of 3 open positions with 1% and spread my edge, or better to have a maximum of 2 with larger position size? Now, here's the thing that I want to get across here. This is a fantastic advanced question, and it's a big part of what I teach everybody in our community, which is you need to make a distinction on how awesome that idea is. If you believe that every single trade warrants the same risk, then by the very definition, you don't have an edge, because that means you think every trade looks the same. It's not the case. And again, I'm going to go back to driving. You can't get on the road every day and just say, I'm going to do 75. That's like saying every day on the road is the same. It doesn't work that way. Some trades are better. Some trades simply are okay. Some trades you should just pass on. So what we're about to finalize here in this conversation with Henry is making the distinction between your position size needs to be up or down based on how good you are at making that distinction of how much do I love this idea. And that will dictate position size, not the fact that you want to trade more. Very important. Now, I'm a big advocate of trading more good ideas because you actually allow your edge to play itself out faster. But even if you take more trades, you still need to adjust your position size up or down based on the quality of that idea. So, for example, if we take a look at CRM last week, which was the idea that we just showed you, at this particular point, that's a pretty solid setup. We pulled back, we held support. There's high probability with all of the bullish order flow over here, and you get paid for it. But then you get some other situations that are kind of going sideways. It's an okay idea because of this bullish price action and the fact that it's holding from the earnings gap, but the stock really hasn't done anything for 4 weeks. So there's really nothing new. So both bullish ideas, but we need to make a distinction of the quality of the idea. CRM has activity. It's a little beyond the optimal entry right now, but PDD, as much as it's bullish and holding the earnings gap, there isn't anything new really in the last 4 weeks. As a matter of fact, we can actually say going all the way back over here, which is in November, we're almost at the same price. Actually, we're actually at a lower price than where we were months ago, even though the stock is up. And that's also taking us into the middle of this box. So I want you to really think about the next time you're looking to accept risk, the next time you're willing to put on a trade, how much do I love this idea? And what does that mean for my initial amount of money I want to put into this deal? If every trade is the same, then you don't have an edge. And it just means you need to spend an extra 15, 20 minutes, 30 minutes saying, what is my edge? How do I know when I have an amazing opportunity and the right moment to buy versus I have a stock that's bullish but might not be an awesome trade right now? There's a difference, all right? Now we're going to start to get into the ideas and how we're going to break everything down for the week, okay? So again, my answer to Henry was 1 or 2% should be based on the quality of the idea. Better ideas warrant initial capital, higher initial capital contribution. More positions must be considered in the context of the market conditions as well. I'm a big advocate of more good positions if you have the skills to find more good ideas. But position size is different from the amount of positions. So here's the goal that you want to accomplish. Working to identify the amount of reasons we like a trade in advance is a skill, but one to strive for because it means you can spot a good trade from a great trade. So here's what I would love to see you put on a Post-it pad. Write on a Post-it pad before you place any trade. And I don't care if you're day trading, swing trading, whatever it happens to be. Is this a good idea or a great idea? And that answer like that will increase or decrease your position size. It is an advanced skill, but one you might as well learn now because a lot of people never learn it because they trade the same way every single time, and that's a mistake. So let's kind of break this down now from an options perspective and how John broke this down. Markets drifted higher into January across the world, sending bears back into hiding. So We're bullish, but not bearish. We're bullish sideways, but not bearish yet, right? January tends to be a very tricky time in the market where leaders become losers and losers briefly become leaders. That's a mouthful, right? Oftentimes to the untrained eye, and that's the whole point of what we're trying to do here on these YouTube videos, train your eyes to notice more. It's the same charts, you're just learning to notice more, okay? All right, there's no rhyme or reason for this, but those who've been following the markets long enough, we chalk it up to a theory known as January effect. This phenomenon happens for two main reasons. So now, reasons, right? What are the reasons I want to buy? What are the reasons we're going sideways? You add these into the equation, that's all going to be about position sizing, right? So the first one has to do with taxes, where shares are bought back cheaper in January, and you're also pushing your taxes off into the next year, known as tax harvesting, right? What also occurs simultaneously is some losing names from last year begin to move higher as portfolio rebalancing take place. Write that down, portfolio rebalancing. And by the way, John, if you don't know John, who is our options guy, I just want to give you some context to where his insights are coming from. He was the head trader at a firm that had $42 billion under assets. So he's kind of giving a little different perspective from a portfolio manager, asset manager perspective, which is kind of big picture thinking for us regular traders, right? Okay. All right. You'll see volatility in popular names from last year that are being sold off in January to be repurchased again at lower levels. Once the smoke clears, not much really changes other than new investors are often extremely confused. So far this year, that was no different. So what's kind of cool is we're seeing the same thing, but from different perspectives. The second occurrence is that often happens in January is institutional rebalancing. So again, John's giving us his institutional background to tell us why we're kind of chopping around right now, going sideways. This often occurs at the end of January when certain sectors or areas of the markets that were overlooked last year start getting scooped up by institutions. So now you want to print that out, take a snapshot or print that out. All you have to do is look at the recent surge in unpopular healthcare sector, and you'll see what I'm talking about. So that's a big breakdown that John is giving us. He's telling us how and why stocks will tend to drift at the start of January. And then we throw into that the massive move in price to perfection at the end of the year. Now stocks are being forced to justify the rally that they had, these new prices and future cash flow. So that's kind of where we're at right now. So it's kind of like they had that massive move, but now the market's basically saying, okay, prove it to me. And I don't know that we need to take any further look on that than what we saw in JP Morgan, which just an amazing, amazing trend, barely a pullback, and then got walloped, which was a little bit of profit taking. So the numbers were not bad, but selling and heavy selling came in last week. So a little bit more price to perfection type of action. Okay, so now I just want to give you a heads up. I like to do this before we get into it. This is where I'm going to get now into the sector breakdown and ideas that I'm looking at for this week. So to kind of answer the question of, is it time to take profits? Right now, I'm thinking that we're sitting at all-time highs. Earnings season's a little bit mixed, and we're seeing a lot of profit taking. So what I have personally done is I am sticking to my profit taking strategy that even though we're at pullbacks right now, if it pulls back into my trailing stop loss level, I am hitting the road despite the fact that we're at all-time highs because we're still going sideways. The market is pretty much chopped around for a month. I'm not quite calling it distribution yet because volume has not expanded during that trading range. So if you're not familiar with what distribution means, basically after a big uptrend, there's buying pressure, buying pressure, buying pressure. That institution eventually has to start unwinding that position. Once that goes into a trading range, and if that trading range is on heavy volume, that's distribution. Now we're seeing a big trading range here in the S&P 500, which as we said is going back all the way into, in this case here, December. What we'd want to do is take a look and see what the volume looks like there. And the volume, while expanded, a lot of this has been around news. So this uptrend for me personally is still valid as long as we're above this 467 level. But because we're sideways, I'm going to stick to my trailing stop loss on profitable trades, and I'll simply reevaluate those ideas. So as far as some of the rotation that I'm actually looking at for this week, we're going to get into banks, we're going to get into healthcare, we're going to get into technology and a few others. All right. So bank stocks took a drubbing on Friday after reporting. So they need a day or two before I look for new entries. And that's what I just showed you in JP Morgan. This was amazing. This would look at the volume here on this selling. I want to see one more push to the downside, maybe two, before I start to look to get involved here again. In spite of that, we have 10 other stocks in the sector worth watching. So that's a mouthful right there. I just want to make sure I come back and really point out what I just said to you. 10 other stocks in the sector that are still valid ideas. So essentially what I'm showing you is financial sector has stacked order flow in 10 stocks versus healthcare, which has over 20. So that's kind of what John is talking about and kind of what we walked through. And I'll give you a quick visual of that. And you want to take a screenshot of this also as well. When I do the research at the end of the week for everybody, and at the end of every day, we start to pay attention to where is the stacked order flow and how long has that stacked order flow been happening. And you can actually see here in healthcare, it's still looking pretty good. Energy is a little bit more on the bearish side, but then when we start to break it down a little bit more, percentages of stocks, healthcare, consumer defensive, and to a little bit lesser degree, technology. So what am I trying to get across to you here? I'm not trying to make you do more work, but I want to show you what work goes into it to increase that conviction. So all I'm doing here is I'm building arguments for if I'm going to put my hard-earned money in harm's way in the market, I want a bunch of good reasons to do that. So hopefully what I'm inspiring you to ask the question is, wow, I'm only saying it had a bull flag or it went up yesterday. That's only one reason, and that's not enough. So just challenge yourself to say, why else would I want to buy this thing other than the fact that it went up yesterday? It's not complicated. You just need to have a structure for putting that together, like I just showed you in the research. Okay. So again, if you want to screenshot some of this, these are the ideas that I'm looking at for this week. Okay. Oh, by the way, this is obviously a big story this week. 10-year back above 4. Keep an eye on that, because when that went higher, that's where the market went down last summer. That's a very big thing. So just to give you an idea of what we're talking about here, you want to have the TNX on your chart. You can actually see here, this rally is where the market sold off. When it started to go down and broke that uptrend, this is where the end of year rally came in the market. So a rally in the 10-year was declining for the market. A decline in the 10-year is a rally in the market. And now you can actually see what kind of stuck here as well. So if you understand how to draw trends, understand how to draw a box, understand how to draw accumulation or distribution, you can clearly see here on this chart, it's stuck. So until it gets above that 4.1 or below 3.8, I'm looking at the 10-year as kind of neutral right now. So you need to have reference points that tell you something changed. Actually, I'm going to come back. That's a really important point. You need to have reference points to tell you something changed. If something has not changed, then there's nothing new. And if there's nothing new, there's no new distinction, which means there's no new trade. Or if you're in an existing trade and nothing changed, then you stay in that trade. I'm actually going to show you a couple of examples of that, but one of the trades is Johnson & Johnson, right? Very simple. Johnson & Johnson rallied, broke out. It's going sideways for about a week and a half, but it's still bullish. Okay. What's the bond ticker? That's TNX. TNX is actually Treasury notes. I'm not talking about the bonds. It's Treasury notes. So anyway, let me get through the rest of the ideas because I want to make sure that we have set up for the week. So some of the ideas I'm looking at this week: Visa and MasterCard paused after a gap and sit inside days heading into Tuesday. So essentially what we're looking at is MasterCard finally got out of this range, bullish gap, and now inside candle heading into today. So this is one of the ideas that I'm looking at today. Look at that bearish wedge on JNJ. I don't see that, Ben. I think we're looking at something different. It actually broke out and it's above that breakout level. So that's the beauty of looking at price action. We can see it differently. I respect your opinion. I'm seeing a little bit differently right now. And thanks for joining us today. I really appreciate that. So insurance stocks, Allstate, Travelers showed relative strength heading into the recent decline. So I'm actually looking at some insurance stocks this week. Again, we're kind of focusing into the financial sector. All right. Asset management companies, KKR, APO, and a few other ones are also at or near breakout levels this week. Again, APO, a breakout, a failed breakout, and now an inside day. So I'm looking at APO, looking for it to break out and stay above this recent level. If it does, great. If it breaks down, fine, leave it alone. Now we get into healthcare. Now this is really where we kind of set up stacked order flow versus just regular ideas. Healthcare remains strong. It set up a few opportunities for the short week. And by the way, today is Tuesday already, right? Pauses and breakouts on the agenda. That's really what I'm looking for. I want some price action that is moving. When we're kind of stuck in a box, there's really nothing to do. So if we kind of work our way through, you can see here that we got some pretty decent levels. And this is really where the frustration has been. We're not getting through those levels to set up new trades, so we really need to be patient. So in this particular case here, ILMN needs to break out through this level, and only until or if it does, then am I willing to do something. So it's got to get over 144 and then look to make a run towards 168. So I want to be clear about this. This is a challenge or a mistake that a lot of traders make, which is they get involved early. The way that you have to think about it is price action is having price discovery. When it's stuck in a box or can't get out of it, that's currently the right price. So what I'm basically declaring here is I like it better over 144, but I don't like it until that happens. So this week, we're kind of setting up a lot of alerts, okay? All right, Amgen with the bullish gap. We're going to take a look at that chart. Now, this is a really interesting one, and I want to point this out because it's important price action to understand. Now, you can actually see here, this is actually showing some nice relative strength, right? It broke out, pulled back, really clean bull flag, and then started again, right? Basic technical analysis. But here's where you really start to separate yourself, and this is what a lot of people don't notice. The price action for the last 4 days is inside of this one big candle on higher volume. So really nothing has changed in this stock for the last 5 days, despite the fact that it showed relative strength to the market. So what I'm really looking at right now is I like the idea, but I like it better when something new has happened. And in order for something new to have happened, we have to get above this candle, not just have a what we call a swing low or well bid candle. So this is a really important distinction to make. We accept risk because new levels, we believe, are being hit or have a good chance. But for the last 5 days and that big candle with big volume, nothing new has happened. So as much as I like the idea, I don't like it as much until it gets above 313-ish. So if we kind of go back to the whole point of today and whether or not it's the time to sell, whether it's the time to place new ideas, I am finding the market difficult to find great ideas right now. And that's a good example because it's stuck inside of that candle. Nothing is new. And a lot of stocks I'm looking at are either way extended or in a box. So I have lowered my position size until I like better reward potential for the risk I need to take right now. And that's okay. I'm okay with going up. There's so much opportunity in the market over the day, the week, the month, especially the quarter and the year. I don't need to force ideas just simply because it's Tuesday and just simply because I love to trade and just simply because the market opens. I want to make money because there's great ideas and I'm okay with allocating capital. If I don't love the market, which I'm flat out saying, I don't love the market right now, I'm finding ideas, but I'm lowering my position size. And I think you need to be okay with that because that's kind of the secret where you're not digging yourself a hole because you trade the same way all the time. And again, I want to say what I said before. It's that important. If you have the same risk for every trade, you don't have an edge. And if you don't have an edge, it's going to be hard for you to see consistency. And if you're yo-yoing back and forth on your P&L and your account growth is just not where you want it to be, and it's certainly not like this, it just means you need to define your edge a little bit better, what happens most of the time, and take action on only those ideas and get rid of all those garbage trades that we know we shouldn't be in the first place. So again, you might want to screenshot this stuff. I'm just going to go through what I'm looking at in the rest of the market for the week. So that was the breakdown in Amgen. J&J trade from last week remains valid. Nothing has changed. Good place to have patience. Nothing changed since the trade. One can make a case that it shows relative strength. So if the market was pulling back and going sideways and this one's bouncing a little bit, it's looking okay. Not flying, moving in our direction, moving slowly, but moving in our direction. All right, and that's the trade right there. So again, we had this big level here. We finally punched through there, and we're going sideways. So there's really nothing to do here. We have pretty good percentage move going back to last year, and that remains in place. And you can see the profit potential that we're looking at. AbbVie traded into an inside candle both Thursday and Friday and closed near a big breakout level. There's the setup that I'm looking for, and there's the breakout. Look at that difference in perspective. That looks amazing pausing up there, and that's a massive resistance level it needs to get through. So again, I like it, but I like it better after it clears those levels. I'm looking for something new. Not yet. First position, looking to add if it takes out those levels. All right, consumer cyclical stocks show trading ranges. Again, look at Hilton. Hilton has been bullish, but now going sideways for the better part of, I don't know, about 5 weeks here. I still love the idea. What I don't love is this heavy volume in the middle of this trading range. So again, you start to spot a little bit different. I want a light volume pause, not a heavy volume pause. Heavy volume pause implies distribution. Distribution implies changing hands. Changing hands implies a potential reversal. I like it. It's still bullish, but I want light volume pause, not a heavy volume pause. Look at the volume here during this pause, which should have continued. It kind of stayed the same, but now look at this volume here. That's a change in volume, which means a change in the tape, which will change my position size. You see how we're starting to put these pieces together? It's nothing that difficult. What do I want to see? What am I seeing? I want to see a light volume pause. I'm seeing a heavy volume pause. I still like it bullish. Heavy volume pause, lower initial position size, add on the next push. Okay? All right. There's a lot of lessons in here. You probably want to watch this one more time. All right. All right. Similar breakout setups today in SKX and PDD. So again, how many more trading range are we seeing in these bullish stocks? This is now going sideways for the better part of 5 weeks. Same thing here with PDD. So I'm really more inclined to be setting alerts right now than breakouts. So look at how simple these setups are for this stock. Okay. All right. Technology had a solid week, but also the ideas are well beyond an optimal entry. So what am I doing now? I'm qualifying technology. A lot of them rocketed higher last week after the pullback to start the year. They're valid bullish ideas, but not trades today. And you can see that here in CRM. Although I do like one trade, which I'll talk about in a second. Microsoft worth a look today as it makes a run to be called the world's most valuable company. That's pretty interesting. And again, multiple week trading range as the stock is now sitting at big levels and paused. So I kind of like this one, looking for a breakout follow through here today. Now I also pointed out today too, any idea that I'm looking for a breakout, I don't get in early. I want new price levels. If it breaks down and it was one of the ideas I was looking at that day, that's fine. Leave it alone. It didn't do what I wanted it to do. Let it go. If it breaks down, leave it alone. If it breaks out, have conviction because we built the idea. All right. So Microsoft looking pretty darn good. Breaking down industry groups a little bit more. Technology dominated the bullish side of the market. So now we're breaking down technology down into a little bit deeper, more granularity into an individual industry group. Okay. Stocks that paused last week. We're now talking about software infrastructure as an industry group, which if we kind of break that down a little bit more in the S&P 500, we have semiconductors, software application, and software infrastructure. So we're going to break that down a little bit more as well. All right. So the stocks that I'm looking at in infrastructure: Microsoft, PANW, CRWD, FTNT, ZX, and NTNX. Software application, we just talked about CRM, and Shop is actually a big one. And so is Uber that I'm looking at this week. As a matter of fact, we could probably throw DDOG in there as well, actually at or near a breakout as well. But again, another example of a stock that needs to clear a level before it makes sense. Okay. So finishing up here, obviously we're talking about AMD this week as well. Semiconductor stocks had a big pop last week, as did SMCI, pulling back a little bit this morning. But I'm watching and have an alert set for SMCI at 355, as well as what I'm looking at in AMD this week, where you can actually see AMD pulled back, paused, and has a level. So really above 151, 151.5 is really the level I'm looking at in AMD. So that's a lot to unpack this week. So I want to be clear. I'm bullish, but I'm not loving the price action because it's not bouncing back and forth. We're not seeing pushes and pauses. We're not seeing, here we go for a 2-week period and then we pull back. We're kind of exploding or going sideways. And for me, that's not perfect price action. I want to be clear about that. That's my price action. That's what I'm looking to see. So I want to challenge you. What does perfect price action look like for you that you have a lot of conviction? That's the question to ask, because the better questions you ask, the better quality of the idea, which is going to influence your position size. So is it time to sell the news right now? Well, we have a lot of sell the news. We have Morgan Stanley coming out today, which is up just a little bit, just reported. We have Goldman Sachs, which reported today, and that's actually up a little bit. It was up a little bit higher. Remains to be seen today whether or not stocks are going to hold that bid. That's the big thing. We have the news, and then we have follow-up. So what we're basically telling the market right now is prove to me you're going to stay there, and then I'll put my money in. When institutions put their money in and they're holding it, I'm going to join them. When they're kind of sideways, chaotic, and all that kind of stuff, I'm not putting bigger capital in because it's my job to shadow them. It's not my job to predict. I don't predict. I pay attention. I know it's still valid, and I know when it's changed. Infinitely easier. Take that a step further and say how much of that's going on in a particular sector or an industry group, and you level up your conviction for the idea. All right? Got a lot to unpack this week. Don't forget, it's a short week with a bunch of economic data coming out this week, retail data coming out this week, a bunch more earnings. So I should get some pretty good volatility. The VIX is way down there, still at 12, 12 and a half. So in that sense, it's not really spiking that much, but plenty of volatility on earnings-related plays, and I'm going to be all over those this week as well. All right? Have an awesome week, everybody. If you have any follow-up questions, definitely leave a comment below in the video. I'll be more than happy to get back to you as well. All right? Have an awesome day, everybody. I'll speak to you soon.